Good morning, gentlemen. Welcome back to Accounting 429, Financial Statements Analysis. In today's lecture, we're going to look at Chapter 5, which focuses on understanding the balance sheet. So let us begin by looking at the learning objectives for today's lecture. So in this lecture, we're going to begin by looking at the different elements of the balance sheet. So we're going to look at the assets, liabilities, and the owner's equity. And then we're going to move on to describing the uses and limitations of the balance sheet in financial analysis. After that, we're going to try to describe the alternative formats of a balance sheet presentation and distinguish between current and non-current assets and current and non-current liabilities. And then we will move on to describing the different types of assets and liabilities and the measurement basis of each. Following that, we're going to describe the components of shareholders' equity. We're going to look how to convert balance sheets to common size balance sheets and interpret the common size balance sheets. And finally, we're going to try and calculate and interpret liquidity and solvency ratios. The balance sheet, which is also called the statement of financial position, is a representation of the accounting equation. So it basically reflects the accounting equation and its representation: assets, the liabilities, and the owner's equity. The IFRS uses the term statement of financial position, where US GAAP uses the two terms interchangeably, so the balance sheet and the statement of financial position. The balance sheet discloses what an entity owns or controls, which is represented by the assets side, what it owes, which is reflected by the liabilities portion of the balance sheet, and what the owner's claims are at a specific point in time. And of course, as I mentioned earlier, from your accounting studies, you already should be aware of the accounting equation that the balance sheet reflects, which is assets equals liabilities plus owner's equity. So here in the equation, you can see that the left side of the equation reflects the resources controlled by the company, and the right side reflects how those resources were actually financed. Is it by financial obligations, or dealing with debt, or is it by the owners of the corporation or the company? The financial position of a company is described in terms of its basic elements: assets, liabilities, and equity. And here we're going to look closer at these different elements and try to understand them. Now pay attention that I'm merely revising these concepts for you. I'm pretty sure that you already aware of these terminologies, since you have most likely have studied accounting 101 or in your other accounting courses. So we begin with the assets, which we usually represent by the letter A for an abbreviation. The assets are what the company owns or controls, and more formally, assets are the resources controlled by the company as a result of past events and from which the future economic benefits are expected to flow to the entity. Where the liabilities, or we abbreviate it by the letter L, are what the company owes. More formally, liabilities represent obligations of a company arising from past events, the settlement of which is expected to result in an outflow of economic benefit from the entity. And finally, equity, E, represents the owner's residual interest in the company's assets after deducting its liabilities. Commonly known as shareholders' equity or owner's equity, equity is determined by subtracting the liabilities from the assets of a company. So we go assets minus liabilities, that should give us our equity value. Now, it is worth noting that the balance sheet provides important information about a company's financial condition, but the balance sheet amounts of equity, assets, net of liabilities, should not be viewed as a measure of either the market or intrinsic value of a company's equity for several reasons. First, the balance sheet under current accounting standards is a mixed model with respect to measurement. Some assets and liabilities are measured based on historical costs, sometimes with adjustments, whereas other assets and liabilities are measured based on a current value. The measurement basis may have a significant effect on the amount reported on the balance sheet. The second reason is that even the items measured at current value reflect the value that was current at the end of the reporting period. The values of those items obviously can change after the balance sheet is prepared. And third, the value of a company is a function of many factors, including future cash flows expected to be generated by the company and current market conditions. Important aspects of a company's ability to generate future cash flows, for example, it is repetition and management skills, are not included in the balance sheet. So we cannot just depend on the balance sheet to evaluate or to put a value on the intrinsic value of the company itself. It is important for you as an analyst to understand that asset composition of firms varies depending on the industry. So going back to Colgate-Palmolive Company, and as you can see here we have a snapshot of the asset portion of their balance sheet. You can see that the assets are typical for a manufacturer. You have cash, receivables, inventories, property, plant and equipment, goodwill, and intangibles. We will examine the main types of assets in later slides. Now for the liability portion of a balance sheet, the types of liabilities are typical for most companies. So normally you would see accounts payable, notes payable, long-term debt, and accrued income taxes. And again, as you can see in front of you here, we have the liabilities portion of the Colgate-Palmolive Company balance sheet. Now for this slide, we see the last portion of the balance sheet, which is the equity or the shareholders' equity portion. So you can see that the items that are represented here are also pretty typical for most companies. It is worth noting that the total equity in this case, which is 2,541, of course this is in millions, okay, equals the total assets, which was 12,724, minus the total liabilities, which was 10,183. And again, we will examine the main components of equity in later slides as well. Now we'll try to understand the concept of liquidity. A company's ability to pay for its short-term operation needs relates to the concept of liquidity. So with respect to a company, overall liquidity refers to the availability of cash to meet those short-term obligations. With respect to a particular asset or liability, liquidity refers to its nearness to cash. So a liquid asset is one that can be easily converted into cash in a short period of time at a price close to fair market value. For example, a small holding of an actively traded stock is much more liquid than an asset like a commercial real estate property in a weak property market. The reason being is that the actively traded stock is much more easily sold and converted into cash at any point in time. Now, when it comes to the ordering according to liquidity, in general, financial statements prepared in accordance with the IFRS present balance sheet information in the reverse order of liquidity compared with US GAAP. For example, using IFRS, assets are presented starting with the non-current assets followed by current assets. And equity is presented first, followed by non-current liabilities and current liabilities. IFRS does not prescribe the reverse ordering. Presentation of financial statements under the IFRS states that the standard does not prescribe the order or format in which an entity presents the items. Here we look at an example for Henkel Company. This is going to enable us to compare this and differentiate between this balance sheet of a company, an European company that follows IFRS, with an American company which was Colgate-Palmolive that uses GAAP standards. Okay, so basically this slide shows the asset portion of the balance sheet for Henkel AG and Company, which is a German company that prepares its financial statements under IFRS. Henkel has laundry and home care, cosmetics, toiletries, and adhesive technologies business. The company has numerous well-known brands, including Persil, Purex, and Dial. Henkel's balance sheet illustrates the following differences from Colgate's balance sheet. First, it illustrates the ordering of assets from least liquid to most liquid, with non-current intangible assets at the top and cash at the bottom. Whereas if you go back to Colgate-Palmolive's balance sheet, you will notice that they have the opposite ordering. It uses the title Consolidated Statement of Financial Position rather than Balance Sheet. It presents the order year 2010 to the left of the more recent year 2011. It supplies the number of the relevant footnote on the face of the balance sheet. And finally, it presents additional columns showing each line item of assets as a percentage of total assets. So basically a common size balance sheet. And on this slide, we have a third example. So this one is for L'Oreal's company. The balance sheet illustrates the following differences from both Colgate and Henkel's balance sheets. Like Henkel and different from Colgate, L'Oreal's balance sheet orders assets from least liquid to most liquid, with non-current intangible assets at the top and cash at the bottom. Like Colgate and different from Henkel, it uses the titled balance sheet rather than consolidated statement of financial position. Also, like Colgate and different from Henkel, it presents the most recent year in the leftmost column. Like Colgate and different from Henkel, it presents the older year 2010 to the left of the more recent year 2011. And finally, it supplies the number of the relevant footnote on the face of the balance sheet, so similar to Henkel and different from Colgate. L'Oreal's balance sheet also illustrates the requirement under IFRS for a third balance sheet as of the beginning of the earliest comparative period presented when an entity restates its financial statements. A key point here to notice is that under both IFRS and US GAAP, the companies are required to distinguish between current and non-current assets and between current and non-current liabilities, and present these as separate classifications on their balance sheets. A balance sheet with separately classified current and non-current assets and liabilities is referred to as classified balance sheet. An exception to this requirement under IFRS is that the current and non-current classifications are not required if a liquidity-based representation provides reliable and more relevant information. And if you notice, all three of the companies we covered earlier in the previous examples show a subtotal for current assets and current liabilities. The separation in the presentation of current and non-current assets and liabilities enables you as an analyst to examine a company's liquidity position, at least as of the end of the fiscal period. We're going to later cover the definitions of current and non-current in coming slides. Here we look at an example that is under IFRS accepted from the requirement that the assets and the liabilities are broken down into current and non-current classifications. So on this slide you see the asset portion of the balance sheet of Barclays PLC, which is a UK headquartered global financial services provider engaged in retail banking, credit cards, wholesale banking, investment banking, and wealth management. And Barclays, even though Barclays reports under IFRS, you can see from their balance sheet here is that they are using a liquidity-based presentation. Now let us try to understand the differences between current and non-current assets and liabilities. So, assets that are held primarily for the purpose of trading are expected to be sold, used up, or otherwise realized in cash within 1 year or one operating cycle of the business, whichever is greater after the reported period, are classified as current assets. A company's operating cycle is the average amount of time that elapses between acquiring inventory and collecting the cash from sales to the customers. For a manufacturer, this is the average amount of time between acquiring raw materials and converting these into cash from a sale. Examples of companies that might be expected to have operating cycles that is longer than 1 year include those operating in the tobacco, distillery, and lumber industries. Even though these types of companies often hold inventories longer than 1 year, the inventory is classified as a current asset because it is expected to be sold within a 1 operating cycle. Assets not expected to be sold or used up within 1 year or 1 operating cycle, on the other hand, whichever is are classified as non-current assets. Current assets are generally maintained for operating purposes, and these assets include, in addition to cash, items expected to be converted into cash, such as trade receivables or accounts receivables, or used up, like office supplies, prepaid expenses, or sold, such as inventories in the current period. Current assets provide information about the operating activities and the operating capability of the entity. For example, the item trade receivables or accounts receivables would indicate that a company provides credit to its customers. Non-current assets represent the infrastructure from which the entity operates and are not consumed or sold in the current period. Investments in such assets are made from a strategic and longer term perspective. Similarly, liabilities expected to be settled within 1 year or within 1 operating cycle of the business, whichever is greater after the reporting period, are classified as current liabilities. The specific criteria for classification of a liability as current include the following. It is expected to be settled in the entity's normal operating cycle. It is held primarily for the purpose of being traded. It is due to be settled within 1 year after the balance sheet date. Or finally, if the entity does not have an unconditional right to defer settlement of the liability for at least 1 year after the balance sheet date. Now it's worth noting that IFRS specify that some current liabilities such as trade payables and some accruals for employee and other operating costs are part of the working capital used in the entity's normal operating cycle. Such operating items are classified as current liabilities even if they will be settled more than 1 year after the balance sheet date. When the entity's normal operating cycle is not clearly identifiable, its duration is assumed to be 1 year. All other liabilities are classified as non-current liabilities. Non-current liabilities include financial liabilities that provide financing on a long-term basis. The excess of current assets over current liabilities is called working capital. The level of working capital tells the analyst something about the ability of an entity to meet liabilities as they fall due. Although adequate working capital is essential, working capital should not be too large because funds may be tied up that could be used more productively elsewhere. Now, in accordance with accounting standards, the companies are required that certain specific line items, if they are material, must be shown on a balance sheet. Among the current assets, required line items are cash and cash equivalents, trade and other receivables, inventories, and financial assets. Companies present other line items as needed, consistent with the requirements to separately present each material class of similar items. Now, cash and cash equivalents are financial assets. Financial assets in general are measured and reported at either amortized cost or fair value. Amortized cost is the historical cost, initially recognized cost, of the asset adjusted for amortization and impairment. Under IFRS, fair value is the amount at which an asset could be exchanged or a liability settled in an arm's length transaction between knowledgeable and willing parties. Under US GAAP, the definition is similar, but it is based on an exit price, the price received to sell an asset or paid to transfer a liability, rather than an entry price. For cash and cash equivalents, amortized cost and fair value are likely to be immaterially different. Examples of cash equivalents are demand deposits with banks and highly liquid investments such as U.S. Treasury bills, commercial paper, and money market funds, with original maturities of 3 months or less. Cash and cash equivalents excludes amounts that are restricted in use for at least 12 months. So for all companies, the statement of cash flows presents information about the changes in cash over a specific period of time. Now on this slide, you can see an example of disclosures regarding cash and cash equivalents from two different companies. The Procter & Gamble disclosure at the top states that the company records cash equivalents at cost, where the L'Oreal disclosure on the bottom illustrates the measurement of cash equivalents at market value. Now, in order to be able to measure trade receivables, it is worth trying to understand what do they represent. Trade receivables or accounts receivables are another type of financial assets. These are amounts owed to a company by its customers for products and services already delivered. They are typically reported at net realizable value and are an approximation of fair value based on estimates of collectibility. Several aspects of accounts receivable are usually relevant to an analyst. First, the overall level of accounts receivable relative to sales is important because a significant increase in accounts receivable relative to sales could signal that the company is having problems collecting cash from its customers. Second, the allowance for doubtful accounts reflects the company's estimate of amounts that will ultimately be uncollectible. Additions to the allowance in a particular period are reflected as bad debt expense, and the balance of the allowance for doubtful accounts reduces the gross receivables amount to a net amount that is an estimate of fair value. When specific receivables are deemed to be uncollectible, they are written off by reducing accounts receivable and the allowance for doubtful accounts. The allowance for doubtful accounts is called a contra asset account because it is netted against the balance of accounts receivable, which is an asset account. So it basically goes under the asset account on the balance sheet, but it has a negative impact on total assets. And it has a credit and debit rule, or the normal balance of such account is the credit side. The age of an accounts receivable balance refers to the length of time the receivable has been outstanding, including how many days past the due date. Another relevant aspect of accounts receivable is the concentration of credit risk. For example, a company's credit risk is more limited when it has a large number of customers diversified across various industries and countries versus only one or a few customers accounting for a large percentage of either revenue or receivables. In this example, we look at an illustration of the valuation of accounts receivable net of allowance for doubtful accounts. So basically the estimated uncollectible amounts for a company. This example also illustrates analysis relating the amount of allowance to the amount of gross receivables. The amount of allowance for doubtful accounts is related to bad debt expense and thus to reported net income. Bad debt expense is an expense of the period based on a company's estimate of the percentage of credit sales in this period for which cash will ultimately not be collected. So the allowance for bad debts is a contra asset account which is netted against the asset accounts receivable. To record the estimated bad debts, a company recognizes a bad debt expense which affects net income, and increases the balance in the allowance for doubtful accounts by the same amount. To record the write-off of a particular accounts receivable, a company reduces the balance in the allowance for doubtful accounts and reduces the balance in accounts receivable by the same amount. L'Oreal's allowance decreased as a percentage of gross receivables over the past 3 years. Now, in general, some factors that could cause a company's allowance for doubtful accounts to decrease as a percentage of accounts receivable include the following. First, improvements in the credit quality of the company's existing customers. So whether driven by a customer-specific improvement or by an improvement in the overall economy. The second is a stricter credit policy. For example, refusing to allow less creditworthy customers to make credit purchases and instead requiring them to pay in cash, to provide collateral, or to provide some additional form of financial backing. And finally, a stricter risk management policy. For example, buying more insurance against potential defaults. In addition to these business factors, because the allowance is based on management's estimates of collectability, management can potentially be biased. Okay, so these estimates basically manipulate those estimates to to affect their reported earnings. L'Oreal's note further discloses that its group policy is to recommend credit insurance coverage as far as local conditions allow. So the non-collection risk on trade receivables is therefore minimized. This is reflected in the level of the allowance, which is less than 2% of gross receivables. On this slide, you can see an illustration of the cost flow of inventory for a company that purchases inventory items for resale, such as wholesalers or retailers. The illustration shows that the measurement basis of inventory on the balance sheet is directly related to measurements of cost of goods sold on the income statement. During the period, the company purchases goods which are added to its beginning inventory. Beginning inventory plus purchases equals goods available for sale. As the goods are sold and revenues are recognized, the cost of goods sold will be removed from inventory and recorded as an expense. Any items not sold during the period remain in ending inventory. It is worth noting that inventory measurement is one area where the differences between US GAAP and IFRS are very noticeable. Inventories are measured at the lower of cost and net realizable value under IFRS and at the lower of cost or market under US GAAP. The cost of inventories comprises all costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. So net realizable value, NRV, the measure used by IFRS, is the estimated selling price less the estimated cost of completing or cost of completion and costs necessary to make the sale. Under US GAAP, market value is defined as current replacement cost but with upper and lower limits. So it cannot exceed NRV and cannot be lower than NRV less a normal profit margin. If the net realizable value, NRV, under IFRS or market value under US GAAP of a company's inventory falls below its carrying amount, the company must write down the value of the inventory. The loss in value is reflected in the income statement. And under IFRS, if the inventory that was written down in a previous period subsequently increases in value, the amount of the original write-down is reversed, and subsequent reversal of an inventory write-down is not permitted under US GAAP. And finally, when inventory is sold, the cost of that inventory is reported as an expense, cost of goods sold specifically. And accounting standards allow different valuation methods for determining the amounts that are included in cost of goods sold on the income statement, and thus the amounts that are reported in inventory on the balance sheet. Inventory valuation methods are referred to as cost formulas and cost flow assumptions under IFRS and US GAAP respectively. IFRS allows only the first in, first out, FIFO, weighted average cost, and specific identification methods. Some accounting standards, such as US GAAP, also allow the last in, first out, which is LIFO or LIFO method as an additional inventory valuation method. So the LIFO method is not allowed under IFRS. Now we move on to the measurement basis of non-current assets, and we begin with property, plant, and equipment. Property, plant, and equipment, or what is referred to in short as PP&E, are tangible assets that are used in company operations and expected to be used or to provide economic benefits over more than one fiscal period. Examples of tangible assets treated as property, plant, and equipment include land, buildings, equipment, machinery, furniture, and natural resources such as mineral and petroleum resources. IFRS permits companies to report PP&E using either a cost model or a revaluation model. Although IFRS permits companies to use the cost model for some classes of assets and the revaluation model for others, the company must apply the same model to all assets within a particular class of assets. US GAAP permits only the cost model for reporting PP&E. Under the cost model, PP&E is carried at amortized cost, so historical cost less any accumulated depreciation or accumulated depletion and less any impairment losses. Depreciation and depletion is the process of allocating or recognizing the cost of a long-lived asset over its useful life. Land is not depreciated because PP&E is presented on the balance sheet net of depreciation, and depreciation expense is recognized in the income statement. The choice of depreciation method and the related estimates of useful life and salvage value affect both a company's balance sheet and income statement. Whereas depreciation is the systematic allocation of cost over an asset's useful life, impairment losses reflect an unanticipated decline in value. Impairment occurs when the asset's recoverable amount is less than its carrying amount, with terms defined as follows under IFRS. Recoverable amount, the higher of an asset's fair value less cost to sell and its value in use. Fair value less cost to sell, which is the amount obtainable in a sale of the asset in an arm's length transaction between knowledgeable and willing parties less the costs of the sale itself. When an asset is considered impaired, the company recognizes the impairment loss in the net income statement. Now, reversals of impairment losses are permitted under IFRS, but not permitted under US GAAP. Under the reevaluation model, the reported and carrying value for property, plant, and equipment is the fair value at the date of revaluation less any subsequent accumulated depreciation. So the changes in the value of PP&E under the reevaluation model affect equity directly or profit and loss depending upon the circumstances. Now, property, plant, and equipment measurement is another area where differences between US GAAP and IFRS are notable. So on this slide, you can see a summary of the key differences between the two standards. On this slide, you can see an excerpt of a disclosure from Portugal Telecom for the fiscal year ended 31st of December 2011. It illustrates the use of the revaluation model under IFRS. Per the disclosure shown, you can see that the original revaluation of the classes of PP&E in 2008 created a revaluation reserve of more than 1 billion, and the revaluation reserve is a component of shareholders' equity. In the current year 2011, the revaluation resulted in a net reduction of 131 million euros, of which 126 million was recognized as comprehensive income and 5 million was recognized on the income statement as part of depreciation and amortization. Here we look at the measurement basis of another type of non-current assets, which is intangible assets. Intangible assets, for example, like patents, which are the exclusive right to a product or process granted by the government to an inventor for a limited period of time. Examples include licenses, which is the exclusive right to perform some activity, typically granted by a government to the purchaser of a license for a limited time, and include trademarks, which are basically the right to word, name, symbol, or device that distinguish goods and services from those manufactured or sold by others. And it also includes goodwill, which is not a separately identifiable asset. It arises when a company acquires another company for a price in excess of fair market value of net identifiable assets acquired. So these are a bunch of examples for intangible assets. Now, the IFRS allow companies to report intangible assets using either a cost model or a revaluation model. The revaluation model can only be selected when there is an active market for an intangible asset, so that fair value can be determined by reference to an active market. Such active markets are expected to be uncommon for intangible assets. So examples where they might exist are for some types of licenses, like fishing licenses or taxi licenses, and these are not really common. US GAAP permits only the cost model. So for each intangible asset, a company assesses whether the useful life of the asset is finite or indefinite. So if the asset's life is indefinite, then no foreseeable limit to the or that means that there is no foreseeable limit to the period over which the asset is expected to generate net cash inflows for the entity. And if the asset's life is finite, that means a limited period of benefit to the entity. Amortization and impairment principles apply as follows. An intangible asset with a finite useful life is amortized on a systematic basis over the best estimate of its useful life, with the amortization method and useful life estimates reviewed at least annually. Impairment principles for an intangible asset with a finite useful life are the same as for PP&E. An intangible asset with an indefinite useful life is not amortized. Instead, at least annually, the reasonableness of assuming an indefinite useful life for the asset is reviewed and the asset is tested for impairment. Note that under US GAAP, at the 2012, they've changed the requirements for a quantitative assessment of impairment for indefinite-lived intangible assets. If an intangible asset is deemed to be impaired, an impairment loss is charged against income in the current period. An impairment loss reduces current earnings. The impairment loss also reduces the total assets, so some performance measures, such as return on assets, may actually increase in future periods. And finally, an impairment loss is a non-cash item. Now we focus more on goodwill. So basically, when one company acquires another, if the purchase price is greater than the acquirer's interest in the fair value of the identifiable assets and liabilities acquired, the excess is described as goodwill and is recognized as an asset. Why might an acquirer pay more to purchase a company than the fair value of the target company's identifiable asset net of liabilities? Well, first, as noted, certain items not recognized in a company's own financial statements, such as its reputation, established distribution system, trained employees, and so on, these things also have value. Second, a target company's expenditures in research and development may not have resulted in a separately identifiable asset that meets the criteria for recognition, but nonetheless may have created some value. Third, part of the value of an acquisition may arise from strategic positioning versus a competitor or from perceived synergies. For example, the acquisition might have been aimed at protecting the value of all of the acquirer's own existing assets. So accounting goodwill is not the same as economic goodwill, where accounting goodwill is based on accounting standards and is reported only in the case of acquisitions. Economic goodwill is based on the economic performance of the entity, and it is not necessarily reflected on the balance sheet. Instead, economic goodwill is reflected in the stock price. Some financial statement users believe that goodwill should not be listed on the balance sheet because it cannot be sold separately from the entity. Other financial statement users analyze goodwill and any subsequent impairment charges to assess management's performance on prior acquisitions. It is worth noting that under both IFRS and US GAAP, accounting goodwill arising from acquisitions is capitalized. Goodwill is not amortized but is tested for impairment, and the requirements are similar to those for indefinite-lived, separately identifiable intangible assets we discussed in the previous slide. If the goodwill is deemed to be impaired, an impairment loss is charged against income in the current period. An impairment loss reduces the current earnings. It also reduces the total assets, and it also need to be noted that it is a non-cash item. Now we take a look at the measurement basis for financial assets. Keep in mind that here financial assets refers to a company's investments in stocks issued by another company, or its investments in the notes, bonds, or other fixed income instruments issued by other companies, or even issued by government entities. So this discussion pertains to investments where ownership does not give the investor control, which could require consolidation, or significant influence, which would require equity method accounting. Generally speaking, there are two basic alternative ways that financial instruments are measured. The first one is fair value, which is the price that would be received to sell an asset or paid to transfer a liability. And the second way of measuring financial instruments value is amortized cost, the amount at which a net asset was initially recognized minus any principal repayments plus or minus any amortization of discount or premium, and of course minus any reduction of or for impairments. Financial assets are measured at amortized cost if the asset's cash flows occur on specified dates and consist solely of principal and interest, and the business model is to hold the asset to maturity, and this category of asset is referred to as held to maturity. Of course, examples include an investment in a long-term bond issued by another company. For example, the value of the bond will fluctuate with interest rate movements, but if the bond is classified as held to maturity, it will be measured at amortized cost. And also a loan to another company would also be measured in the same way. Financial assets not measured at amortized cost are measured at fair value. How are any unrealized net changes in fair value recognized? We have two alternatives to do that. The first one is that we can recognize them as profit or loss on the income statement, or as other comprehensive income or loss, which bypasses the income statement. Now note that these alternatives refer to unrealized changes in fair value, such as changes in the value of a financial asset that has not been sold and is still owned at the end of the period. Unrealized gains and losses are also referred to as holding period gains and losses. If a financial asset is sold within the period, a gain is realized. So if the selling price is greater than the carrying value, and a loss is realized if the selling price is less than the carrying value. When a financial asset is sold, any realized gain or loss is reported on the income statement. Now, the category of held for trading or trading securities under US GAAP refers to a category of financial assets that are acquired primarily for the purpose of selling in the near term. Such assets are likely to be held only for a short period of time, measured at fair value, and any unrealized holding gains or losses are recognized as profit or loss on the income statement. the category of financial assets measured at fair value, with any unrealized holding gains or losses recognized in other comprehensive income, are referred to as available for sale assets under US GAAP. They are not trading assets, but they are available to be sold, referred to as financial assets measured at fair value through other comprehensive income under IFRS. At the time a company buys an equity investment that is not held for trading, the company is permitted to make an irrevocable election to measure the assets in this manner. Now we move on to types of current liabilities, and here you see four of the most common types of current liabilities that appear on balance sheets. Okay, so first we have the trade payables, also known as accounts payable, and these basically are amounts that a company owes to its vendors for purchases of goods and services. In other words, the unpaid amounts of the company's purchases on credit as of the balance sheet date. An issue relevant to analysts is the trend in overall levels of trade payables relative to purchases, a topic to be addressed further in ratio analysis when we come to cover ratio analysis. Significant changes in accounts payable relative to purchases could signal potential changes in the company's credit relationships with its suppliers. After that, we have notes payable, which is basically a financial liability owed by a company to creditors, including trade creditors and banks, through a formal loan agreement. Any notes payable, loans payable, or other financial liabilities that are due within 1 year or the operating cycle, whichever is longer, appear in the current liability section of the balance sheet. In addition, any portions of long-term liabilities that are due within 1 year are shown in the current liability section of the balance sheet. Then we'll look at accrued expenses, also called accrued expenses payable, accrued liabilities, and other non-financial liabilities. These are expenses that have been recognized on a company's income statement, but that have not yet been paid as of the balance sheet date. Examples include income taxes payable, accrued interest payable, accrued warranty costs, and accrued employee compensation, which is basically the wages payable, or salaries and wages payable. And finally, the deferred income, which is also called deferred revenue and unearned revenue, that you've probably covered in your accounting course. This basically is the income that arises when a company receives payment in advance of a delivery of the goods and services associated with the payment. The company has an obligation either to provide the goods or services or to return the cash received. Now, examples of this include lease payments received at the beginning of the lease, fees for servicing office equipment received at the beginning of the service period, and payments for magazine subscriptions received at the beginning of the subscription period. When it comes to non-current liabilities, we have two common types of non-current liabilities. There are long-term financial liabilities and deferred tax liabilities. The long-term financial liabilities include loans, which is basically borrowings from banks, and notes or bonds payable, i.e. fixed income securities issued to investors by the company. They are usually reported at amortized costs on the balance sheet. At maturity, the amortized cost of the bond carrying amount will be equal to the face value of the bond. Example of this would be if a company issues 10 million of bonds at par. The bonds are reported as a long-term liability of 10 million. The carrying amount, or the amortized cost from issue to maturity, remains at 10 million. Another example, if a company issues 10 million of bonds at a price of 97.50, so a discount to par, the bonds are reported as a liability of 9,750,000 over the bond's life. The discount of 250,000 is amortized so that the bond will be listed as a liability of 10 million at maturity. Similarly, any bond premium would be amortized for bonds issued at a price in excess of the face value. In certain cases, liabilities such as bonds issued by a company are reported at fair value. Those cases include financial liabilities held for trading, derivatives that are liability to the company, and some non-derivative instruments such as those that are hedged by derivatives. Now, the other type is deferred tax liabilities. These are amounts of income taxes payable in future periods with respect of taxable temporary differences. They result from temporary timing differences between a company's income as reported for tax purposes, or the taxable income, and income as reported for financial statement purposes, the reported income. They result when taxable income and the actual income tax payable in a period based on it is less than the reported financial statement income before taxes and the income tax expense based on it. They typically arise when items of expense are included in taxable income in earlier periods than for financial statement net income. The difference between taxes payable and income tax expense results in a deferred tax liability. For example, when companies use accelerated depreciation methods for tax purposes and straight line depreciation methods for financial statement purposes, taxable income is less than income before taxes in the earlier periods. Now let us look at the components of shareholders' equity, being the last item that is usually represented on the balance sheet. Capital contributed by owners, also known as common stock or issued capital, which is the amount contributed to the company by owners. Ownership of a corporation is evidenced through the issuance of common shares. Common shares may have a par value or stated value, or may be issued as no par shares depending on regulations governing the incorporation. Disclosures for each class of share issued by the company, par or stated value, if one exists, based on the regulations of the country. Number of shares authorized, so the number of shares that may be sold by the company under its articles of incorporation. The number of shares issued, which is the number of shares that have been sold to investors already. And finally, the number of shares outstanding, which is the number of issued shares less treasury shares. Now, another components of shareholders' equity is the preferred shares. These are shares that have rights that take precedence over the rights of common shareholders. Preferential rights generally pertain to receipt of dividends and receipt of assets if the company is liquidated. Classified as equity or financial liabilities based upon their characteristics rather than legal form. So, perpetual non-redeemable preferred shares are classified as equity. Preferred shares with mandatory redemption at a fixed amount at a future date are classified as financial liabilities. So you need to pay attention to that detail. Another component is treasury shares or treasury stock or own shares repurchased. These are shares in the company that have been repurchased by the company and are held as treasury shares rather than being cancelled. A company is able to sell or reissue these shares. A company may repurchase its shares when management considers that the shares are undervalued. It needs shares to fulfill employees' stock options, or it wants to limit the effects of dilution from various employee stock compensation plans. A purchase of treasury shares reduces shareholders' equity by the amount of the acquisition cost and reduces the number of total shares outstanding. If treasury shares are subsequently reissued, a company does not recognize any gain or loss from the reissuance on the income statements. And finally, the treasury shares are non-voting and do not receive any dividends declared by the company. Another component of shareholders' equity is retained earnings. Retained earnings are the cumulative amount of earnings recognized in the company's income statements that have not been paid to the owners of the company as dividends. Recall that beginning retained earnings plus net income minus dividends equals ending retained earnings. So this is basically money generated by the business activity that is kept in the business for the purpose of reinvesting for future projects. Accumulated or other comprehensive income, AOCI, also known as other reserves. Okay, the cumulative amount of other comprehensive income or loss. Other comprehensive income refers to income that is not recognized on the income statement. And recall that beginning AOCI plus other comprehensive income equals ending accumulated or other comprehensive income. After that, we look at non-controlling interest or minority interest, which is basically the equity interest of minority shareholders in the subsidiary companies that have been consolidated by the parent or the controlling company, but that are not wholly owned by the parent company. This balance sheet example is for L'Oreal, and it shows the equity and liabilities portion. Remember that L'Oreal is a French cosmetics company that prepares its financial statements under IFRS, and L'Oreal's balance sheet, based on that, orders liabilities from least liquid to most liquid, with non-current intangible assets at the top and cash at the bottom of the balance sheet. Now we get to the analysis of balance sheets. Before we start with how can we analyze balance sheets, it is worth looking at the concepts of liquidity and solvency. So liquidity refers to a company's ability to meet its short-term financial commitments. Assessments of liquidity focus on a company's ability to convert assets to cash and to pay for its operating needs. Solvency, on the other hand, refers to a company's ability to meet its financial obligations over the longer term. So assessments of solvency focus on the company's financial structure and its ability to pay long-term financing obligations that they have. Okay. Now, in order to better understand this, consider two people. One of them has a large house valued at $10 million, but has only 200 reals or $200 in their bank account, and another gentleman who has a small house that is only worth, let's say, 500,000, but he has a bank account of 1 million reals or $1 million. So the person A and person B will have different abilities to meet their financial obligations. So the second person would be in a much better position to pay any let's say utility bills or phone bills at the end of the month because he has much more liquidity and much more cash readily available to be used to settle any financial obligations that arise in the near future. Now, for the tools that are used normally to analyze balance sheets, we have two main tools. The first one is common size analysis, just like we've done with the income statement, where we use percentages to represent each item of the top line item in the income statement. So we used to use a percentage or to calculate the cost of goods sold, for example, as a percentage of revenue, and calculate how much is net income as a percentage of revenue. Okay, so similarly, we can do that for the balance sheet. And the other analytical tool is the use of ratios. Okay. Here we have an example of common size balance sheets. So remember that common size balance sheets show each line item on the balance sheet as a percentage of total assets. Common size statements facilitate comparison across time periods, so time series analysis, and across companies, so cross-sectional analysis, because the standardization of each line item removes the effect of size, just like we've studied for income statements. This format can be distinguished as vertical common size analysis, the one that you see in front of you, and this discussion pertains to vertical common size analysis. So as the chapter on financial statement analysis discusses, there is another type of common size analysis which is known as horizontal common size analysis. It states items in relation to a selected base year value. Okay, but for us here we're focusing on the vertical common size analysis. The example presents partial income statements through operating profits for 3 hypothetical companies operating in the same industry. If you can see that company A and company B, each with 3,250,000, are smaller as measured by assets than company C, which has 9,750,000 in assets. Okay, so how can an analyst meaningfully compare the financial position of these three companies against each other? Through the use of common size balance sheets. Okay, remember that common size balance sheets help us eliminate the effect of size, or the size difference between different companies that we are comparing. So after we transform the data given in the previous slide into a common size balance sheet, we get the information that you see in front of you. And we begin our analysis by looking at liquidity. And as you can see, current assets relative to current liabilities affect the assessment of liquidity. So in this case, company A is more liquid than company B. For company A, current assets are 77% of assets versus current liabilities at 0%. For company B, current assets are 68% of assets versus current liabilities at 77%. So referring back to the dollar amounts, company A shows no current liabilities. Basically, its current liabilities round to less than 10,000. And it has cash on hand and short-term marketable securities of 1.9 million to meet any near-term financial obligations it might have. So in contrast, company B has 2.5 million of current liabilities, which exceeds its available cash and securities of only 200,000. How will company B pay its near-term obligations? Company B will need to collect some of its accounts receivable, sell more inventory, borrow from a bank, and or raise more long-term capital by issuing bonds or more equity. Okay, so from that we can clearly see that company A is more liquid than company B. Company C, on the other hand, is also more liquid than company B. It holds more than 30% of its total assets in cash and short-term marketable securities, and its current liabilities are only 6.2% of the amount of total assets. Now, composition of current assets affects assessment of liquidity. So most of the assets of company A and B are current assets. However, company A has nearly 60% of its total assets in cash and short-term marketable securities, whereas company B has only 6% of its assets in cash and marketable securities. Let us look at solvency next. So typically assessed by examining both capital structure and coverage, the ability to generate income and cash flow sufficient to cover interest and principal. And because this presentation pertains only to the balance sheet, it examines only capital structure. And from our example here, we see that company A is more solvent than company B or C, because less than 1% of company A's assets are financed with liabilities. Based on these numbers, it seems very unlikely that company A would have difficulty paying the interest and principal on its long-term bonds. And 98.5% of company C's assets, on the other hand, are financed with liabilities. So if company C experiences significant fluctuations in cash flows, it may be unable to pay the interest and principal on its long-term bonds. Other observations we can see from our example as well is that common-sized balance sheets can also highlight the differences in company strategies. So comparing the asset composition of the companies, we can see that company C has made a greater proportional investment in property, plant and equipment, possibly because it manufactures more of its products in-house. Company B's balance sheet shows goodwill. This signifies that it has made one or more acquisitions in the past. In contrast, the lack of goodwill on the balance sheets of Company A and Company C suggests that these two companies may have pursued a strategy of internal growth rather than growth by acquisition. And finally, Company A's balance sheet has relatively little inventory and no accounts payable. What could explain this composition? It either has not yet established trade credit or is in the process of paying off its obligations in the process of liquidating. It may be in either a startup or liquidation stage of operation. Caveat, being more liquid or more solvent does not necessarily translate into better. At the extreme, the most liquid and most solvent company would hold only cash as an asset and be financed only with equity, i.e. no debt. But it could not be argued that would mean this company is best. A wide range of factors affect a company's liquidity, management, and capital structure. So in practice, differences across companies are more subtle, but the concepts are similar to those illustrated here, and the analysts noting significant differences would do more research and seek to understand the underlying reasons for the differences and their implications for the future performance of the companies. It is also worth noting that the numbers presented in these examples might vary greatly depending on the industry or the sector that the companies you're analyzing operate in. So you need to keep that in mind as well. And finally, we get to the last learning outcome for today's lecture, which is looking at the balance sheet ratios. We'll begin here by the liquidity ratios, and then we'll move on to the solvency ratios. So the balance sheet ratios are those involving balance sheet items only. Each of the line items on a vertical common-sized balance sheet is a ratio in that it expresses a balance sheet amount in relation to the total assets. So other balance sheet ratios compare one balance sheet item with another. For example, the current ratio expresses current assets in relation to current liabilities as an indicator of a company's liquidity. The current ratio expresses current assets in relation to current liabilities. It quantifies how many dollars, or whatever reporting currency, of current assets the company has to pay each dollar of current liabilities. A higher ratio indicates a higher level of liquidity, i.e. a greater ability to meet short-term obligations. A current ratio of 1 would indicate that the book value of its current assets exactly equals the book value of its current liabilities. A lower ratio indicates less liquidity, implying a greater reliance on operating cash flow and outside financing to meet short-term obligations. The quick ratio expresses the more liquid current assets, sometimes referred to as a quick assets, in relation to current liabilities. It quantifies how many dollars, or whatever reporting currency of course, of quick assets the company has to pay each dollar of current liabilities. Like the current ratio, a higher quick ratio indicates greater liquidity. The quick ratio is more conservative than the current ratio because it includes only the more liquid current assets in the numerator. The quick ratio reflects the fact that certain current assets such as prepaid expenses, some taxes, and employee-related prepayments represent costs of the current period that have been paid in advance and cannot usually be converted back into cash. The quick ratio also reflects the fact that inventory might not be easily and quickly converted into cash, and furthermore, that a company would probably not be able to sell all of its inventory for an amount equal to its carrying value, especially if it were required to sell the inventory quickly. In situations where inventories are illiquid, as indicated for example by low inventory turnover ratios, the quick ratio may be a better indicator of liquidity than the current ratio. And finally, the cash ratio. It expresses cash and marketable securities in relation to current liabilities. So it quantifies how many dollars of cash and securities the company has to pay each dollar of current liabilities. The cash ratio normally represents a reliable measure of an entity's liquidity in a crisis situation. But in general market crisis, the fair value of marketable securities could decrease significantly as a result of market factors, in which case even this ratio might not provide a reliable information. And finally, the cash ratio reflects that there can be a time lag involved even in turning receivables into cash. Also, please remember that being more liquid or more solvent does not necessarily translate into better. At the extreme, as we mentioned earlier, the most liquid and most solvent company would hold only cash as an asset and be financed only by equity. Okay? So they will be debt free. But it could not be argued that would be best. Okay? Because of course debt has its own tax benefits, and when a company holds all of its assets in cash, that means they're not really doing much with it. So they're not really utilizing their assets properly. Okay, so the key here is to find a balance. The company needs to have enough cash to be able to cover its obligations, but nothing more than that. It needs to utilize the rest of its assets into its operations and in activities that actually can generate profits to the company. And now we look at the solvency ratios. So as you can see in this slide, we have 5 of the most commonly used solvency ratios to analyze a financial position of a specific company. For most of these ratios, the calculation is implicit in their names, and generally, the greater the debt in a company's capital structure, the greater the financial risk and the less solvent the company is. For this class of ratio, a higher ratio indicates weaker solvency, and of the ratios listed here, only the total debt, also known as debt to assets, can be found directly on the company's financial statements. So let's look at these one by one. The first one, the ratio of long-term debt to equity. This one measures the amount of long-term debt capital relative to equity capital. For example, a ratio of 1 would indicate equal amounts of long-term debt and equity. A higher ratio indicates a higher financial risk and thus weaker solvency. The second one is ratio of debt to equity, which measures the amount of debt capital relative to equity capital. For example, a ratio of 1 would indicate equal amounts of debt and equity. Debt includes both short-term debt and long-term debt. A higher ratio indicates higher financial risk and thus weaker solvency. The third one is total debt, also known as ratio of debt to assets. It measures the percentage of total assets financed with debt. For example, a debt to asset ratio of 40 or 40% indicates that 40% of the company's assets are financed with debt. Generally, higher debt means higher financial risk and thus weaker solvency, as we mentioned before. The fourth ratio is the ratio of debt to capital. This one measures the percentage of a company's capital, debt plus equity, represented by debt. A higher ratio generally means higher financial risk and thus indicates weaker solvency. And finally, the financial leverage ratio. This one, often called simply the leverage ratio, measures the amount of total assets supported for each one money unit of equity. For example, a value of 3 for this ratio means that each $1 of equity supports $3 of total assets. Again, the higher the financial leverage ratio, the more leveraged the company is, in the sense of using debt and other liabilities to finance assets. This ratio is often defined in terms of average total assets and average total equity and plays an important role in the DuPont decomposition of return on equity that will be discussed in a later chapter. That was it for chapter 5. Thank you very much for listening. In this chapter we looked at the balance sheet, we looked at the presentation of balance sheets and the classification of current and non-current assets and liabilities. We looked at accounting issues that relate primarily to measurements of balance sheet items, so historical costs versus fair value principles. We looked at tools for balance sheet analysis, including the common size analysis and the balance sheet ratios, liquidity ratios, and solvency ratios. So I appreciate your time and participation in this lecture, and now I'll be happy to answer any questions that you might have. Thank you all for listening.